So, Ann, the data is painting sort of a confusing picture. Retail sales in February looked weak, but factory and manufacturing activity looks set to rebound. What kind of course does this put us on?
Yeah, I think that's a great question, and thanks for having me on here in New York this morning. Investors will particularly focus on manufacturing because what we've seen is a weakness in manufacturing all across the globe because of the trade tensions. So this is something that really investors would want to look at. This will give a boost to market sentiment in our view. When it comes to the retail sales side, I mean, this is particularly interesting and important, of course, for the U.S. because the consumer is the driver of the U.S. economy. So I think going forward, I mean, the overarching theme still is for the global growth, also U.S. growth, some slowdown. But in between, we might see some rebound as trade tensions fade. We might see a resolution here, according to which then also manufacturing might rebound a bit.
You know, it goes with, Andrew, what we got out of China, which is private survey showing that manufacturing activity expanded unexpectedly. We've been asking whether we can call a bottom in global growth and what it's going to mean for the markets. Is that where we are?
Yeah, I mean, I think we're getting past some of the early Q1 weakness that we saw. We had, obviously, in the United States, we had a government shutdown to start the year. And I think as we kind of thaw out this spring, the data is going to start turning around and we're going to start kind of going back towards trend growth after a weak Q1. But I think there's a lot of reasons to be optimistic going forward.
There's a big discussion about Q1 earnings expectations, right, which are negative, and Q2 is nothing to write home about. But revenue expectations aren't as bad. We're looking for 4% plus. Can we get by on that, on top-line growth this earnings season?
Yeah, well, I think in line with some rebound in economic data, we might see also some small rebound in earnings. But to be fair, the margins, they will be compressed from two sides. I mean, as we had a bit later into the year, top-line growth might go a bit lower. And at the same time, we see some cost pressures coming up from rising wage costs, not only in the U.S., but also a phenomenon that we see in Europe and in other places.
Are you, is an earnings recession, quote unquote, your base case?
No.
Two quarters?
No, it's not our base case.
Andrew, how about you?
So I think at the end of the day, our earnings growth seems to be slowing from last year, but let's keep in mind how strong of a year 2018 was. And so I think now we know we have central banks on the side of kind of risk markets, and after kind of going into the year thinking that quantitative tightening was going to be this big problem around the world, it seems that central banks have reversed course and kind of made a dovish pivot everywhere. So I think that gives markets a boost going in for the rest of the year.
So, Andrew, what's your strategy right now? We've been talking about, you know, all the superlatives around how great the first quarter was, which I think we should also include how bad the fourth quarter was. We're kind of even here and back to 5-month highs in the market. Where do we go next?
Yeah, so I'm a bond guy, and so looking at yields, if we have a kind of slightly inverted yield curve now, and I think that was giving a lot of people some concern, but I think that the inverted and flat yield curve this time isn't sending the same signals it has in the past, quite frankly, because the main reason being that an inverted Treasury curve has not corresponded with an inverted bank curve, and banks' margins have actually been increasing as the Fed's been hiking rates and the Treasury curve's been flattening. So I think that's a positive, and that's something that as we go forward, that you're not going to see banks contract lending like they typically would in a flat yield curve environment.
And how would you answer that question?
So I remain underweight duration.
Oh, go ahead. Did you want to finish, Andrew?
Oh, sorry about that. Yeah. Sorry about that. No, go on.
No, I was just going to ask your thoughts on where we go next in the markets and maybe tying in Andrew's view. He says the yield curve doesn't matter.
No, I think the yield curve inversion this time is different from past inversions because it's been driven by the long end, not so much by the short end, so by tighter end monetary financial conditions. But that said, coming back to our view on markets, so from a multi-asset context, we would still be a bit skeptical about the rally in equities that we've seen since the beginning of the year. So clearly what you can see is that the markets on the one hand and risk sentiment on the one hand and the economic data on the other hand, they are marching at a different beat. So in our view, to become a bit more constructive in a multi-asset context on global equities, we would like to see a more convincing stabilization and rebound in economic data. And today's manufacturing figures might be a good sign in that, but let's wait for more convincing data here on a broader base before we become more constructive.
So you'd want to see China data continue to moderate, or would you want to see Germany turn? Where would you look first?
So I think Europe is, of course, in terms of size, not as important as China and the US, but clearly it's still 20% of the global economy, and we would have to see some rebound here in European data. We've seen a long strike of disappointing data in Europe, but also due to some technical factors, some idiosyncratic factors, such as the protests in France or a disruption in the auto sector in Germany. So this might well then go out of the data in the coming weeks.
Andrew, any implications for the bond market of the politicization of the Fed? The president is tweeting about it. Larry Kudlow on CNBC Friday calling for a cut.
Yeah, I mean, certainly it doesn't make the Fed's job any easier, but I do think that Powell and the rest of the FOMC will look past this. Now, obviously, I'm sure they would prefer to not have the administration kind of signaling where they want rates to go. At the end of the day, it's going to, the Fed's going to rely on the data. And if the data comes in kind of stronger than expectations, the Fed's going to continue eventually to normalize rates. Obviously, they're in a prolonged pause at this time. But as we kind of go on throughout the year, if the data improves, I look for people to start putting rate hikes back in play and look for yields to rise on the Treasury curve.
What is your expectation for hikes or cuts in 19?
Yeah, so, I mean, the market's pricing in almost, if you look at the Fed funds futures curve now, the market's pricing in almost 2 cuts over the next year and a half. And I think that's kind of off base. At the end of the day, the Fed has signaled they're in a pause. I think there's no doubt about that. But the one thing that I think is going to be more important than the past numbers, which is it used to be that we looked at the jobs numbers every month and those were the most important. I think the bigger thing going forward is going to be what inflation does and inflation expectations, and those have started to trend higher. If you look at financial conditions and inflation expectations, they've kind of reversed to where they were in October, even though the Fed's made this extremely dovish pivot. So I look for the Fed. I think we could have a rate hike by the end of the year in the fourth quarter. And I think that at the end of the day, you can see more hawkish language if the data improves and inflation starts trending higher. So I haven't given up on this rate hiking cycle yet.